All right, we'll go ahead and get started. There's a few people I can see participating right now. There might be some more coming in as I get home from work or whatever it might be. So what I wanted to do tonight, can you all see the screen right here? Coronavirus and your finances open Q&A?
Yes.
Okay, great. So what I wanted to do was just put something together with, based on everything that's going on in the news and obviously what's been going on with the stock markets and everybody's investments going to crap. Just have something where people could get together, just ask any questions that you might have and just kind of talk about things. Very informal, but, just give people an opportunity to voice whatever concerns they might have or questions. So I've got a little bit prepared, a few slides prepared. I'll go through some of those, and then we'll go through some of the questions that came up that people presented or emailed to me in the last week. And then if there is anything that pops up along the way that, triggers another thought that you might have or any other question or comment that comes up, there should be a little chat feature on the bottom of your screen. Feel free to put anything into there that you like, and we'll go through and I'll hit those on the back end. Okay?
Okay.
All right. So as we get going here. All right. Most of you know, my name is Jeff Burke, financial planner with 7th Street Financial. So let's go through with what's happened. Obviously, in the last month or so, we have seen almost an unprecedented turn in the markets. This chart here is from the Dow Jones for the past, or basically since the first of the year. And as we can see, the Dow is down 30%, S&P almost 28, NASDAQ 24. This was through the end of day yesterday. Now, we've had certainly times before where the market has taken hits like this. What's been different about this one, though, is the sheer speed and velocity, though, at what this has happened. This has been, and hopefully we're at a bottom. I'm not in a position to say that we are or are not, but we have lost all this value in just 30 days, which is record-breaking speed for this sort of decline. Now, to kind of show that, here we have a chart showing the 10 biggest one-day point losses in the history of the Dow Jones. Now, prior to the coronavirus, we had only had 2 1,000-point losses in the history of the Dow, both occurring in February of 2018. We've now had 5 more, 3 of which have been 2,000-point losses, one of which awfully very close to being a 3,000-point loss. So again, the massive volatility that this has had has been almost unprecedented for the market performance. Now, I had sent an email out to some clients earlier when this was going, probably sometime back in February, when we were much earlier in this outbreak process, trying to compare this to how the stock markets have compared to other previous outbreak situations. And as we can see here with some of these other ones that have happened so far in this since 2000, in every one of those cases, the market was down, basically between 6 and 13%. I think at the time I sent this, we were down 10. So we were kind of right in line with that. What that shows also, though, is 6 months after the outbreak is done, how the market has bounced back. And I was trying to, ease people's concerns that, hey, we should be, we're going through a short-term thing right here, and history shows we bounce back pretty quickly from these. So not realize at the time this was going to go to the extent that it did. But it's also interesting to note when you look at how this is done compared to some of those others, the sheer number of cases on this absolutely dwarfs what we saw with the SARS, MERS, and Ebola. Zika had a large number of cases, even more so than we've had with Corona, but only 18 deaths from that whole Zika thing. So certainly a very low death rate. Obviously, there was other issues with the Zika that weren't great, but from a death perspective, much more contained than what we've seen with Corona. So this is, at least in modern times, from a health perspective and an outbreak, unlike anything we've kind of dealt with before. So there's one other thing that we can try to compare it to if outbreaks really don't work, and that's the financial crisis that we went through right about 10 years ago, a little over 10 years ago. What was different with the financial crisis, though, is that was stretched out over a much longer period of time. That actually took us 17 months from October 07 to March of 09 to hit the bottom. That was a total of a 53% decline in the Dow. So let's hope we don't get there. So far, we've been at about 30, and let's hope it just stops right there. Other issues that were kind of different with that, note where really the underlying problems with the financial crisis started all the way back in 05, probably fall of 05, where mortgages starting defaulting, and all the way through 06. But it really took a long time for that to work its way into the financial markets. The other thing is we were much slower with our response on that. The Fed kind of started putting out fires on a one-off issue as early as March 08 when they bailed out Bear Stearns. And again, that's 5 to 6 months after that October 07 peak. Then from a federal perspective, the Congress didn't pass the bank bailout until October of 08, so another 7 months beyond that. The other federal stimulus didn't get passed for another 4 months until February 09. So the sheer amount of time that it kind of took for us to get our stuff together during that whole time really led to us being in a much deeper recession, and coming out of that took so much longer. So what I do take comfort in and what we've been going through here is that our agencies that can help us with that have acted much quicker and much more decisively and in much bigger steps. Now, obviously, we still need to pass this federal stimulus package, which I had thought was going to pass today, but it still sounds like there might be a hang-up or two there. But assuming that gets done in short order, you can see we've acted much quicker in this, and hopefully that will kind of cap or put a, hopefully maximize, try to cut off the damage that's been done to the economy as a result of this. Now, as we go through this, it's, obviously our investments have not done well, but what are some of the things you're looking at to stay financially stable as we go through this tough time? I really kind of go back to what I call the fundamentals of financial planning. Number one, live within your means. Just spend less than you're taking in. There is a current opportunity here. The fact is there's not that much to spend money on right now outside of groceries and some basic life necessities. So this is an opportunity to cut back on that discretionary spending. Much easier to get living within your means because of that. And then if you've got that opportunity, set some of that money aside for longer term in case that need comes up. Second is have manageable debt levels. I like to get a little bit more conservative than this. I know the bank guidelines are at like 36%. I'm much more comfortable with people having 25 to 30% of their gross income going towards debt. If you are above that, again, things can start to get pretty dicey pretty quick if something were to happen to your income or your job situation. Then let's have emergency savings. The target is to have 3 to 6 months of living expenses kind of stashed away in a savings account. Again, this is a good opportunity. Take advantage of some of the savings you might incur with all the other areas of life that are shut down. That leaves you with some money left at the end of the month. Great opportunity to stick that into your emergency savings fund to help you better ride this out in the future. And then finally, be patient with investments. I know that has been very difficult probably as this has gone on and you see these huge drops on a daily basis and as fast as this has happened. But this is a good opportunity to use this to rebalance the portfolio as the equity. If say you're like in a 70-30, 60-40 portfolio, as that equity portion goes up and up and up, it's really tempting to just stay there and ride that hot hand. But I think here we're learning that lesson that says rebalance it and maybe take some of those gains that you've gotten from the equities when it starts to get out of balance and put those back into more of a fixed income situation. Hopefully that'll kind of buffer this out and smooth out your the downside here that we're going through. Secondly, selectively maybe change out some of your individual investments. I'm certainly not recommending just cash out of everything and sit off on the side, but it is a good opportunity to look at some of the individual funds that you might have in your portfolio and say, is this one really going to do me much good, and should this really be a fit moving forward long term? And then finally, is this an opportunity to revisit your risk tolerance? Financial planners, when we work with clients, we try to get an assessment of what their tolerance for risk is, have them fill out some questionnaire, survey, whatever it might be. And I think the tendency is people tend to be more risk tolerant when filling that out on paper. And then when you live through it in something like this, you probably learn what the real risk tolerance of somebody is. And that's okay if it's in real life different from what you put on paper. I think this gives us a chance to reassess that and understand if we do need to make changes to your portfolio mix to say, hey, should we be skewing a little bit more conservative moving forward? Because if somebody kind of panics and is really uncomfortable with what they've been going through in this situation, maybe the right thing is to fix that and get a little bit more conservative moving forward. So that's kind of what I had for just some intro slides. We'll get into the Q&A part of things right now. And before we do that, I do want to give a disclaimer on this. Kind of have to do this legally here. Please, anything that we talk about here, this is general advice. Even if you're the one who has posed a question and I'm answering that, it may not necessarily, please don't take whatever I say to be that is specifically meant for you and that should be a green light to take that specific course of action for you. You really need to consult with somebody to make sure that any specific action is appropriate for you and your overall goals and everything else. So with that being said, I will jump into I'll stop sharing this. Okay, we'll get into the video here and get into the questions that have been asked. All right, the first question that came in is, what do I know about guaranteed income funds? So guaranteed income funds, it's the type of thing that title sounds possibly very enticing right now. Right, as we see our equity values drop, want a product with, there certainly sounds like there's a lot more safety to that. Normally a guaranteed income fund is going to come from an insurance company. It could be something similar to an annuity. I'm generally not a huge fan of investment products that come from insurance companies. But it doesn't mean that they don't have a place at all in your portfolio. One of the reasons I'm not a huge fan of them is because they tend to have very high fees and expenses, and the income that they generate is very conservative. So you might get somewhere between a 2 to 4% guaranteed income rate, and you're paying pretty hefty expenses on those. There might even be, you're locked into it for a certain period of time, like a penalty to get out of the investment. So that's why I'm not a real big fan of those. Now, if your risk tolerance is such where you're willing to give up some of the potential upside of the equities, and you just really, really, really want that peace of mind of that being guaranteed, I think there is a place for that in your portfolio. But otherwise, I think you're better off in the long run taking on some of the risk, but getting the much bigger upside in the equities. Even when the equities fall, I think you're still probably going to, in the long run, come out ahead with the equities than you would with a guaranteed income fund. Second question that came in: do Roth conversions make sense in this environment? I'll take a step back in case anybody doesn't know what a Roth conversion is. We'll explain that really quickly. So think about your 401k and your IRA plans. The money you have in there has all been pre-tax money. So the government has never gotten a penny of money from the taxes that's gone into those accounts. A Roth account is exactly the opposite. The money is taxed before it goes into the account, and then you get whatever ends up being the value of the account, you get to pull out tax-free. Whereas with the 401k and the IRA, once you start removing the money from the account, every single penny of that is taxed. So what a Roth conversion is you can basically reclassify money in an IRA account as though it belongs in a Roth and transfer it into a Roth account. So whatever that money is that you reclassify, you have to recognize as income in the current year, pay income taxes on it, but then it moves into the Roth account and you get the tax-free growth from there. So this is actually a really good opportunity to do Roth conversions if it makes sense for you. And here's why. Let's assume and you had $1 million IRA portfolio coming into the Corona situation. And based on the years that you're expecting before you need to tap into it, that had the potential to grow to $2 million. All right. You were going to have to pay taxes on every penny of that $2 million. Now let's assume it's an average thing and it shrunk 30%, so you're down to $700,000. If you've got the resources and you were thinking of, I can maybe handle converting $100,000 of that fund into a Roth and where I could pay the taxes on that $100,000 of additional income that you have to recognize, you now get the opportunity to basically convert 15% of your portfolio instead of 10%. And all of that, let's assume everything bounces back, that will all then be tax-free moving forward. So yeah, I think this is a good opportunity for people who have the resources to do the Roth conversions. I think it's great for, very good for opportunity to do that. Another question that came in was, is this a good time to buy individual stocks, or should you look at index funds, assuming we're going to get a good recovery? Very good question. I think in this immediate term where we're at right now, this is kind of a stock picker's paradise. I certainly don't recommend that everybody go out and just start buying shares of individual stock. That's certainly a much riskier endeavor than it is buying index stocks. But I do think that there are some things going on right now where it's like 08, 09, where every single thing got beat up and is down pretty significantly. And I think there are some opportunities out there if you're looking at absolute best-in-class type of companies that have the balance sheets and the cash on hand to keep operating and shouldn't miss a beat once things get back up and running. I think those companies are going to be very well positioned to succeed here. There's probably going to be some other competitors that aren't going to do as well, maybe fold up shop, or are going to be prime targets for possible purchase acquisition at a lower cost, get gobbled up by some of those bigger players. So I think in some of those opportunities, there might be some chances to get on some to buy some individual stocks versus an index fund. Then I think once things kind of smooth out and we stabilize, index funds would be the way to go moving forward from there. If you take a look in the last couple of days, even Boeing is up 60% in the last 2 days. That's an incredible return on that one. Some of the other airline cruise stocks, as they're awaiting the news from that federal stimulus package, have had tremendous bump ups. Those are obviously kind of flyers that you would take there. But, there are some companies like an Apple, Microsoft, places like that have still taken 20, 25% hits. Those are some of the best companies in the world. So there are some opportunities there. There are going to be some other companies in an index fund that are probably going to be slower to recover. But so possibly immediate term, individual stocks, you can make some hay, but eventually I think index funds will be the way to go long term. A second question with that one, kind of related to that, was how many investments should somebody have? I think for the most part, when we're looking at our portfolios, the key thing that we want to have good diversification. amongst different asset classes. To do that, you can probably achieve that with, I'd say, 8 to 10 is a good number to have. Honestly, anything over 10, you might be starting to get too cute with some things, unless your portfolio is of a size where you want to take some chance. It gives you an opportunity to maybe dabble in some other types of investments. But that's the number I would look at. I try not to go any more than 10 in people's accounts, because I do want to get them a wide variety of, international, emerging markets. We want to have in our domestic, we want to have large cap, mid cap, small cap, and we want to have some different types of fixed income accounts in there, possibly a real estate. So that's about where we get to 10. I've heard other advisors talk about you can do the whole thing in 3. I think that gets a little simplistic. I'm not sure you get as well diversified with 3 as getting, like, say, up to 8 to 10. Another question that came in was trying to understand the difference between the dividend paying stocks and interest paying bonds, wondering if those are better to have than, and especially on the stock side, are those better than non-dividend paying stocks? So a couple different things to address there. Dividend paying stocks versus interest paying bonds, is there a better way to go there? They really serve different purposes in your portfolio. Bonds are really part of that fixed income part of your portfolio. So again, when we talk about portfolios being a 60-40, 70-30 mix, the first number being the equity portion of your portfolio, the second part being fixed income part of your portfolio, that's where those bonds come into play. And they serve a purpose in the portfolio. One, they're kicking off income to you in the form of interest. But 2, they are much less volatile than equities are. So as we hit times like this, where we've seen, depending on the stock fund, I've seen some small cap stocks specifically have really been crushed during this. I've seen some of those funds being down 40%. The worst bond fund that I've seen that I'm kind of tracking is down like 10. Some of them are even flat. So that's kind of why we have the bonds in there. So I don't know that there's really those two things can both have place in your portfolio, and they serve different purposes at the same time. Now, as far as, is a dividend paying stock better than a non-dividend paying stock? No one real great answer for that. They're different type of stocks. So the dividend paying stocks tend to be stocks from companies that are a little bit more mature, probably less growth oriented. So what you're going to see with those types of stocks historically, and this is kind of generically speaking, they're going to be less volatile. You may not get the upside in those stocks. They're going to be more steady eddies, and then you're going to get this nice dividend income. Whereas more of a growth stock, younger company, you're looking for more explosive growth out of that from the capital gain perspective. And they're in that process of reinvesting all of their any profits, anything like they've got it back into the company, not paying that out to the shareholders. As a result, trying to grow the business very quickly. There, you're going to see more rapid increases in the share price of a stock as compared to, so they're a little bit more risky with those. The dividend paying stock, a more mature company. So if you think about who are the big dividend paying stocks, today, think of firms like Johnson & Johnson, those type of ones, companies that have been around a very long time, very stable, not that sexy. They're not going to have most likely not going to have a 35% run up in 1 year in one of those stocks. It's probably going to be 5 to 8, and you're going to get a nice 3-4% dividend out of it. Whereas something else, you're kind of crossing your fingers, right? Hoping that growth stock is going to go up 20, 25%, and you're not that worried about the dividend part of it. So it's not necessarily that one's better than the other. It also kind of depends on, again, where your risk is. If the dividend part of your portfolio is probably a little bit less risky, because again, they're more mature companies and probably not susceptible to that downside. that a non-dividend paying company is. So hope that answers that question. One last question that came in beforehand, and I can see that we've got another one waiting here in the chat room. So please, again, feel free to add things into the group chat. We'll get to those here in just a minute. What happens to your money if an EFT or mutual fund closes? This came up, I believe someone was concerned about having, a mutual fund or an EFT if it's got a real small balance, maybe hasn't been doing well, and all of a sudden they go ahead and that fund gets shut down. Do you lose your money? The answer is no, you don't. The reason this can happen is some of these funds, especially some mutual funds, ETFs specifically, can get very niche heavy. They might target in on a real narrow focus band of companies, a particular segment of the market. And there just may not be a huge market for investors in that little segment. And so, there are expenses with running those. And if there just isn't the volume of assets in those funds, the investment company just may not be making much money off of it and say, the hell with it, this isn't worth running. We're going to go ahead and close it down. The ETF and mutual fund, they own the assets. I mean, they own the shares of stock. So as long as those still have value, you just get paid that money out. They may decide to transfer your shares into a different mutual fund or ETF that the same management, if you're, say, with like a Vanguard or a Fidelity, they decide to close down a fund like that, they just may move your investment into another fund that they manage, but you're not out the money. Okay, let's see here. We've got one thing that's come in since we started. Let's see, from Don, with the rebalancing you described, would you propose that after some recovery? What is the timing? So what I try to do with clients is have kind of that more official meeting once every 6 months. And that's part of the prep that I do for those meetings, is go through and assess where the overall portfolio is, given kind of what we had established for your target. And so generally that 6 month time frame usually works out to be okay. And if you start getting out of whack, then we can kind of recommend, all right, let's move, shift between some different individual assets within the portfolio to get you back on target. I don't know if you need to wait until after the recovery specifically, because what you might see right now is, with the equities taking as big of a hit as they have, your portfolio might be overweight fixed income possibly, right? So say your target was a 60-40, you might be sitting now at a 50-50, maybe a 55-45. Probably might want to move more into the equities now so that you can capture that bounce back. So I don't know that I would wait until after the recovery. I think if your 6 months is, if it's ready to rebalance, I don't think you need to really wait for any one event on that. And then I think it's something that you want to keep an eye on throughout the year. And anytime you start getting out of whack with that, probably a good time to rebalance, just so you're not caught off guard if an event like this happens. Okay. So that's it. I don't see any other questions out there right now. If somebody has one, feel free to type it in. Otherwise, is there anything else anybody have? I'm going to go ahead and unmute people. So if they do have anything to say, feel free to speak up. Oh, here we go. We got a couple more. Vinoth, good to see you. Hope everything's going well for you as well. Carrie, besides bonds, what other fixed income products do you recommend? So I like to keep things fairly simple. There are, if you get really into the weeds with investing, there are certainly a litany of products out there that you could get into in the fixed income space. One of my tagline is financial planning for the 99%. I try to keep things fairly basic and not get, like I said, too overly complicated with it. The one other main, what I would consider fixed income product would be real estate. That would be the other product that I would put into that portion of a portfolio. And there are, whether you're looking at owning physical real estate. Oh, did I cut out? Sorry about that if I cut out. The other part of the fixed income portfolio I would look at would be real estate, in case anybody didn't hear that. There's a couple ways to get into that. There's physical real estate, if you want to own a rental property, sort of a thing. The other way to get into that is looking at a REIT, real estate investment trust. You can buy a mutual fund or an ETF to get to dabble your feet into real estate without having to own physical property. Finally, will the Twins win the World Series? Good question. I'd love to see it happen. I'm going to say no, but hopefully. Vinod, is it a good time to pick up equity stocks ETF right now, or would we wait? Great question, Vinod. I think it really depends upon where you're at from a risk tolerance standpoint. I certainly think we are headed for additional volatility. I don't think we are out of the weeds on that. I'm really looking at four things before I would say maybe we're kind of in the clear. And so far, we've only really cleared the hurdle on one of them. The first one being big action on the monetary front, and that's what our Federal Reserve has done. And they've been very aggressive, way more so than they were in the financial crisis, but being very aggressive in making money available to businesses so that they can keep their business running. We've done a very good job with that. Number two is the federal stimulus package, which we're on the edge of getting that, but not quite there yet. Then three is to get to a point where we've got the number of cases leveling off, and then four, finally getting a cure. That's obviously going to be much longer term. Now, the markets are going to react well in advance of those. So I think if you've seen even just the promise of the federal stimulus package, we've had, 2,500 point gain in the market the last 2 days just waiting for that to happen. So I think there will be more additional good news if and when that gets done. Then finally, when we get to see the number of new cases leveling off, there will be another big advancement, I think, in the market at that point in time. Now, in the meantime, we might be seeing terrible economic news. We haven't gotten any of the news yet. I think tomorrow the first unemployment numbers come out. I expect those to be bad, and I expect them to continue to get worse in the following weeks. We're going to see, GDP numbers coming out, earnings from companies. I think all this is going to be bad news. You might see the stock market go up, though, during that time because where they're anticipating the good things that are going to be coming. So you could be looking at some stocks right now. I talked a little bit about that earlier. I think, Vinod, you were a little bit late joining. There are some real big blue chip companies out there that I think will come through this very well. And if you've got the appetite to dip your toes in that water, and I certainly don't cash out of everything that you're in to go buy individual stocks, but if you've got a little section that you want to carve out and say, hey, I'm going to kind of, go for it with this, I think that's fine. I just expect there to be more ups and downs with that over the next, coming weeks and months possibly. Once things smooth out, then I think the ETFs will probably be the way to go. All right, good question. Okay, anything else out from anyone out there? No? Okay. Give it another minute here. But I want to say, all of you guys, thanks for joining. This is the first one of these I've done. So I hope the technology worked okay. I hadn't done this before, but it looks like everybody at least was able to get in and participate. I kind of thought 5 people. I would have been thrilled with 5 people showing up. So we have more than that. And I know most of you as my family in one way, shape, or form. So thank you very much for supporting me. Appreciate that. Anyway. All right. Thanks, everyone, for the comments. Appreciate that. Anyway, if there's nothing else, what about banking? Specifically, what about banking? Roy.
Dottie's trying to type.
Okay.
Oh, can you hear me? Oh, can you hear me? Have you got me off mute?
No, you're good. I can hear you, Dottie.
Oh, okay. So what about the stability of our banking industry right now? Do you think that we're going to become affected that way at all?
I think our banking system overall is very healthy. Coming out of the financial crisis, there was a series of legislation that was put in place, specifically the Dodd-Frank Act, which put a bunch of sort of rules in place as far as how healthy the banks have to be. Those banks get what's called stress tested multiple times a year to make sure that they can that they're meeting all those thresholds. So our banking system, I think, is very healthy. Now, the real things could potentially kind of fall off a cliff, and where the banks could be hurt is, if this goes on for an extended period of time, if the amount of stimulus that the government is providing just is inadequate, and we have a long-term, I know some people are talking about 20% plus unemployment coming out of this. If we get a long-term 20+% unemployment, that could definitely put a strain on things. That's a worst-case scenario. We're hoping we don't get there, and that the things that they're proposing to do in these stimulus packages takes care of the workers, provides incentives for the businesses to keep the people employed, so that when we come out of it from the health perspective, they're ready to run. But overall, our banks are in pretty good shape. Much better than they were in the financial crisis.
Hey, Jeff, it's Vinod here. Sorry, I would have been late. Actually, I'm late. Probably would have answered some questions earlier as well.
No problem.
I just want to understand a little bit on, what's the, intent, and then also what kind of services that you are actually providing, from like smaller service to whatever the comprehensive, service, just a little bit overview. That'd be very helpful.
Sure. On the
so I'm sorry
services
if
I
I'm
provide.
repeat.
Yeah. So I try to make it very. I will scale my services depending upon what the person needs. The different areas that I will look at with people are, that financial fundamental piece that I talked about before, which is your debt management, budgeting. That's kind of like the lowest level of stuff. Insurance reviews, making sure that you've got the right coverage for yourself. I don't sell insurance, but definitely take a look at it and evaluate where you're sitting to make sure you're, from that risk management perspective, you're in good shape. And then we get in college planning is a specific service. Then we get into the investment management, retirement planning, and then making sure that your estate planning stuff is in order as well. And I'm willing to work with you on any one of those, all of them. A comprehensive would cover all of those. But, if all you need is help in just one particular area, I'm happy to work with you on that as well. That answer that, Vinod?
Yes, it does.
Okay.
Yeah, no, I'm trying to kind of understand the services, and then also, sort of services that you provide. And then, so I can get some kind of understanding in there. I think we talked about it like a while ago, and I'm glad that you're doing the Zoom and it works out well too. Yeah, good to see you.
Yeah, thank you.
It's been years.
It has been. The other thing to note with that is I will also work with clients on various lengths of duration. If you just want to be that ongoing client, we have a long-term relationship, that's great. But if you just kind of want to do a checkup and just say, hey, I want somebody to look at my stuff, tell me how I'm doing, and then that's it, I'm happy to do that as well. Or just kind of do even hourly planning if you just have a couple of questions and want some advice on things. If you don't need a couple hours of time, willing to do that as well.
Gotcha. So you do, you only advise, or would you take the money and then would you actually, and then are you running a fund and then would you make money on the fund as well to
No,
return
so
back to investors?
I do not take any money directly from clients. Clients, if there are investments that I manage, I try to get people over to. I've got a relationship with TD Ameritrade. They are my custodian. You have access to your own account there. I'm just labeled as the advisor on that account. That gives me access to go in and execute transactions on your behalf. So no, there's no fund that I'm running. That's a totally different ballgame. I just want to advise on the accounts that you have.
Gotcha. So once the accounts have been created, and then you will sort of probably take it over or probably monitor to do some whatever options or whatever that you think would be best to do, depending on the risk that we agreed on, and then we have talked upon it. Am I getting you right?
Yep, that's correct. Yep. So the process would be, some of my clients are on the call here, and they've got accounts that are not under my purview at TD, that are other places as well. Some are, some aren't, and that's fine. So open up, if you would like that, you can open up an account at TD, transfer those assets in, and then, then that's available for me to know at that point. But if you want to keep stuff outside of that, like if you've got a 401k at a company that you're currently working with, keep it there, right? That can stay over there. You can still provide advice on what you should be doing within that account, but that doesn't.
Right. Gotcha.
Yep.
And hey, and then there's just one more last question. So would you be able to share your historic performance on, especially on these options calls and whatever, that actually makes money long term? I mean, just trying to understand, your strengths. So, I can at least, a little bit.
So like specifically around the options?
Yeah, options and, opportunity, tradings and, transactions, whenever that.
Sure.
Sort of like historic percentage, that's it.
Okay. So let's see here. There's some things I can talk about there. So when it comes to options, it's not really something that I have most of my clients do. I don't have currently any of my clients playing that options space, just because it's a little bit, that's definitely a more, that's certainly a higher level type of investment and understanding and with risk in there than it is just simply having mutual funds, ETFs, or even just buying a company stock. So I don't really get into that space, but if that's where your risk tolerance is, certainly open to that. There are opportunities. It is definitely an opportunity to make more money quickly when you're playing with options, because you can essentially buy the right to buy a share of stock at a fraction of the price. So I don't know if anybody wants a very brief explanation on how an option would work, but like the standard one would be to buy a call, which means there's a market out there that says, say for example, 2 months from now.
You want to go on a W?
Mom, I'm going to mute you. Let's say 2 months from now, a share of Apple stock, $270, is $270. You might pay $2 for the right to buy a share of Apple stock at $270. Now, if you think Apple stock is going to be worth $300 2 months from now, that's a very good $2 investment. right? Then you just turn around, you sell the stock at 300, and you've pocketed that difference by only investing $2 instead of having to lay out $270 up front. So that's, and likewise, you can do that with selling of option, with selling for options as well. So that world gets a little bit more complicated. So I don't really have clients do that. I keep things a little bit more straightforward. But if that is something you're interested in, can certainly discuss it. Now, as far as, you know, I'm not sure, I didn't totally catch what you were saying on like percentages and things like that. We're actually not allowed to talk about like our investing performance per se. The reason for that is because it's too easy for us to cherry pick and say, oh, I had one client, you know, I had this client who did X, you know, this great return in 3 months, you know, and just not mention that, yeah, I also had him in a fund that lost 30% as well. So from a disclosure standpoint, that's not something we're really able to talk about.
Thanks, Jeff. Appreciate
Thank you,
the
Vinod.
information.
Okay, anybody with anything else? This has been great. Good back and forth. I was anticipating this lasting about 20 minutes, so the fact that we're almost at 50 is very surprising for me. Okay, so I don't see anything else coming in. Again, thank you all so much for attending. This was great. I really appreciate you joining and listening. Hopefully you got something useful out of it that you can take back and apply to your own situation. So in the meantime, you know, until we get through this, just please take care of yourselves and each other. And if you have any other questions or anything, contact me. You guys, if you're able to get to this, I'm sure you know how to reach out and contact me. So hopefully I'll hear from you all soon. All right. Thank you. Good night, everyone.